people think that paying $10,000 US for a 2-page form is a good deal? Is that a good deal? So it's roughly 13,300 Canadian at today's rate. So not a good deal? Okay. That, unfortunately, is the deal that you're going to have with the IRS if you're late on one of their forms. So we'll leave that to the back burner for a bit, and I'm going to talk about some of the life cycle tax issues that you will face when you have a U.S. trade or business. Okay. So the first question that I guess people would have to decide when you have a U.S. trade or business is what form is that going to be taking. And the three most common forms that that you would conduct a U.S. trade or business in would be a U.S. branch, a U.S. sub, or an LLC. A branch basically is the sort of the simplest form that you can take, but there is drawbacks to that because of the fact that the Canadian company doesn't have a separate legal entity down in the U.S. There is potential exposure of the Canadian company's assets should there be a U.S. lawsuit. And the branch form basically is used only when you anticipate losses in the U.S. because what happens is the U.S. branch's loss can flow up to Canada. By far, the most common form is in the form of a U.S. sub. And what you get with that is you pay the standard U.S. corporate tax rate, and then on profits coming back to Canada, there's a 5% withholding tax under the treaty. And the pluses with that form is that there is a separate legal entity, so there's legal protection. The U.S. compliance is easier because it's always harder to do a branch return than a regular corporate tax return. And also, last but not least, a lot of the U.S. business, they actually prefer to deal with a U.S. entity versus a Canadian entity. So, so it's not just for tax reasons, it's also for your sort of day-to-day business activity. The last option is probably not a very good one. This was popular before, but there were some changes to the treaty that made this option very bad, actually. And what that is because an LLC is treated as a corporation in Canada, but as a flow-through in the U.S., so the LLC, from a U.S. tax perspective, is regarded as a hybrid. And because of the fact that it's a hybrid, you could actually lose your treaty protection because of the fact that it's not treated on a consistent basis in Canada and in the U.S. So if you have to use the LLC, what you should be doing is you should either put a U.S. HOCO on top, that's a regular C corporation, or you can just check the box to treat the LLC as a corporation for U.S. tax purposes. So now that you have this, hopefully a U.S. sub set up, and we have seen a lot of this, is then the Canadian parent wants to transfer some of the assets that it already has to this new U.S. sub. And let's just say that that's a piece of land in Nevada. That's a mine, okay? And one thing that a lot of the clients tend to miss or overlook is the fact that when you do that transfer, there is potentially FIRPTA implications. FIRPTA is the U.S. Shorthand for their rules that pertains to U.S. real property interest in the U.S. And whenever a foreign person disposes/transfers a U.S. RPI or a U.S. real property interest, there is a 10% withholding tax on the gross proceed on the sale/transfer under 1445, and then there's also a 35% net tax on the gain. Of course, that 10% is going to be a credit on the tax, but there is withholding tax on the transfer. And this umbrella is actually pretty broad in that real property is defined to include the standard stuff, right? Land and building. But it also includes things like personal property that's used on the land. So it's not just the land and building, but it's also stuff that you use on the land to dig a hole to do the mining. And also on top of all that, the sort of the fact that you have this and you do a transfer, technically you have to be withholding that 10%. One way to get around that is you do what is known as a non-recognition transaction. And what that is that the Canadian parent transfers the US real property to the US sub, but then it takes back stock in the sub. And under US rules, that's known as a 351 transaction. So basically, that means that the transaction would not be subject to tax, even if you have a gain. But there's a couple of things that you have to meet to get this non-recognition treatment, and the main one is that the Canadian parent has to control the sub, which usually is not a problem. The potential problem is under A97E of the Internal Revenue Code, where they require, on top of having control, that the transferee U.S. corporation be a U.S. real property holding corporation. And what that is that the U.S. sub really has to be a dedicated mining company. It can't really have much other assets. And so the threshold there is 50% of the U.S. sub's assets must be in the form of U.S. real property interest. So even if we meet this requirement under 351 and A97, where it is a non-recognition transaction, there is still housekeeping stuff that you have to do. Namely, you have to provide the IRS with notice within 20 days of the transfer that this is what you have done. And you have to tell them under what code provision you think this transfer is non-taxable in order to avoid this 10% withholding tax. And of course, Canadian companies don't really know about all that, and so there's many cases of missed notices that should have been submitted to the IRS. And in the olden days, what you would have to do is you have to apply to the IRS for relief under Treasury Regulation 9100, which involves a pretty substantial user fee, and that ranges from $2,000 to $10,000 US, depending on the gross receipt of the taxpayer, and it takes a very long time. So the IRS came with this RevProc back in 2008 that basically says, we understand that so many foreign taxpayers are unaware of these rules, so we're going to streamline the process whereby as long as you tell us you have reasonable costs, you don't have to pay a user fee, and we're going to waive the withholding tax. But the key to all that is that you still have to have a reasonable cause as to why this notice was late. Otherwise, you could be subject to penalty and interest. The other thing that you could do to get around this withholding tax is that if you're able to prove to the IRS that your ultimate gain on this sale is less than 10% of the gross proceed, you can then withhold at that lower amount. So say that your gain is only $10,000, but your gross proceed is $5 million. Then you withhold at that lower amount, 35% of the gain versus 10% of the gross proceeds. But nothing is easy with the IRS. When you apply for this thing, you have to prove to them what your basis is for that property and what is the proceed that you're getting from that property. So basically, you have to give them copies of the purchase agreement and the sales agreement. And then the IRS would give you a letter that basically says you're off the hook for the withholding tax. You still have to file a tax return. And all this is fairly important because if you don't go through with these requirements and the IRS finds you, there's a 25%, basically that's 5% a month, but the max is 25. So there's a 25% failure to file, and a 25% failure to pay penalty. So that adds up to a pretty nice percentage, plus interest. And the last bullet point I can't stress more is, on the form where you apply for the withholding certificate, the IRS states in no uncertain terms that they can go after corporate or people who run the corporation, not just the corporation. So just be careful on that point as well. Okay, so now you have the US sub with this property, and you're going to have to find a way to finance the operation of the sub. And what we see a lot is we see Canadian companies basically pumping down cash to the US sub, and they would call it loan to US sub, but it bears no interest, and it has no fixed terms of repayment. So the problem with that then is this whole thing under Code Section 385, where the IRS has the ability to look at the substance of the transaction and say whether or not that is a true debt or not. Whereas the taxpayer under the regs under 385, the taxpayer is bound by form. Form meaning how has the taxpayer treated this amount on its return, and how has this amount been classified on the financial statements. So it's not a level playing field. So the IRS could come back and say, well, good try, but we don't think that's a debt, right? And then what happens with that is you lose your interest deduction because it's not a debt, right? And also on top of that, they have rules under 163J that will limit the deduction in the US to the extent that the US sub is highly leveraged. Usually the yardstick is 1.5 to 1 in terms of debt versus stock. And also, under 267, related party interests generally cannot be deducted in the US until you actually pay it. So I guess it really doesn't matter what you call this. In order to get a deduction, you have to jump through a few hoops here. And the other thing that we sort of tend to see a lot is a few years later down the road, the US sub is not sort of striking gold, things are not going well, and the Canadian parent goes, okay, you know what, we're just gonna write off that debt on our books so that this loan that we have to the US sub, we're gonna clean it up and we're just gonna set that to zero. And then from a US tax perspective, what happens there is then the US sub could or would have potential cancellation of debt income or COD income because of that. And that amount would be subject to tax at an average rate of 35%. And that income amount is basically computed as if the debt were settled at zero. Because basically the Canadian parent just said that you don't have to pay back the debt, right? So the amount that the US sub paid to settle the debt is zero, and the amount of the debt is whatever that amount is, so the entire amount of the debt would be included in the US sub's tax return as income inclusion. But there's a way out of that, and what happens is, if to the extent that the US sub is not solvent, then COD income can be reduced up to the amount of that sub's debt amount over the fair market value of its assets. So to the extent that the US sub has very, very little worth, you wouldn't have to include the entire amount of the debt in COD. But the flip side is, the IRS goes, well, you can't have your cake and eat it too. So to the extent that you don't have that COD inclusion because the sub is not solvent, you're required to reduce the tax attributes of the US sub, starting with loss carryover. So basically, you have a trade whereby there's no COD inclusion, but you need to grind down your tax losses, and you need to grind down your tax basis. So one way that you can plan around this is you contribute that debt to capital, but you don't take back shares. So you simply have the Canadian parent contribute the debt to the U.S. sub without the U.S. sub shares being taken back. And what happens in that scenario for U.S. tax is the U.S. sub is deemed to have settled the debt at the amount equal to the Canadian parent's basis in that debt. And normally that basis is the amount of the debt, right? So there is no COD income. And we have seen cases where the client actually made the mistake of cutting some shares of U.S. sub back to the Canadian parent. And that's not a good idea, because under the U.S. tax rules, when there's shares that's actually being cut from the sub to the parent, the fair market value of that share is the consideration that the sub pay, quote unquote, to settle the debt. So to the extent that the value of the shares that the U.S. sub gives back to Canco is less than the amount of the debt, guess what? You have COD income. So the best thing to do is not to have share being issued by U.S. sub to parent, but simply contribute the debt to capital. Now we go full circle and we go back to the thing that I raised at the start of my discussion, and that is whenever there is related party transaction between a foreign person and a 25% owned U.S. corporation, you have to file this form called 5472. And the reality is that you need to be filing this form even if the U.S. sub has got a huge loss for the year, or it has no activities in the year, or when there's no new loans being made during the year. Because how the form is laid out is you have to always show the beginning and the ending balance. So if the loan amount from the Canadian parent stays static, you still have to show and disclose that amount each year, even if there's no change. And the downside of not filing this form is pretty bad. There is a $10,000 US per form. So if you had a US sub that is, that has had related party transaction with 2 Canadian companies, say, that's $20,000 US per year. And the IRS, in the olden days, the penalty was not assessed automatically. You have to go through a manager level. They have to look at the situation and sort of do it that way. But since about 2009, because perhaps a shortage of cash at the Treasury, the penalty assessment is automatic. So whenever you have a return that goes to the IRS that has one of these forms that is late, the penalty notice will come to you in about a month or two. So be careful about that. The only way to waive this penalty is you write a waiver letter to the IRS stating your reasonable cause. And one good thing about this is under the IRS's own penalty manual, they actually say that ignorance of the law sometimes can constitute reasonable cause. And that scenario, will give you a reasonable cause to the extent that you acted in good faith, which is a term of art, and you are not expected to know about the law. So one thing that people tend to argue with some success is that the fact that, given the Canadian management and sort of the key people being based in Canada, how can the taxpayer be expected to know this law? So that's a very common sort of pushback when there's a penalty assessment to the IRS. And I would say that in combination with some other factors in your favor gives you a pretty decent chance of getting that waived, but there's no guarantee, obviously. So that's sort of the US landscape in a quick 10-15 minutes. Feel free to write down any questions that you have, and we'll try to answer them.